You are listening to Off the Shelf, a podcast by The Conference Board.
Hello, my name is Klaas de Vries and it's a pleasure to welcome you to this edition of Off the Shelf, a book discussion series brought to you by the Conference Board. Today I will be sitting down with Stian Westlake to discuss his latest book, Restarting the Future, How to Fix the Intangible Economy, which he co-wrote together with Jonathan Haskel. Stian Westlake is chief executive of the Royal Statistical Society, which is a non-profit company that promotes statistics for the public good. And I guess for our American audience, the Royal Statistical Society is an affiliate of the American Statistical Association. Then briefly on the co-author, Jonathan Haskel. He's a professor of economics at Imperial College Business School in London and an external member of the Monetary Policy Committee of the Bank of England. The book we're talking about today, Restarting the Future, is the second book that Stian and Jonathan wrote together. I'm happy to have Stian on today to discuss their latest book. Stian, welcome to the show.
Thank you for having me.
So, Restarting the Future is in many ways the sequel to your earlier book that I just briefly mentioned, Capitalism Without Capital. In that book, you and Jonathan Haskel describe the rise of the intangible economy and its consequences. Now, before we get into that, could you give a very brief description of what an intangible economy entails and how it has evolved over the last decades?
So, when we talk about the intangible economy, we mean an economy where the majority of investment that businesses are doing is intangible capital rather than tangible. What I mean by that, once upon a time, what most businesses invested in was physical things, things you could stub your toe on, as it were, machines, buildings, vehicles. Over time, this has been a long, slow moving change over the last 50 years. That has gradually shifted so that businesses are increasingly investing now in things that you can't touch or feel, like software or data, brands, design, R&D, artistic originals and creative output, things like that, that in the same that like all capital creates a long-term value and incurs an upfront cost, but is generally not a physical, tangible thing.
And so, what was the major impetus for writing this sequel, this Restarting the Future? I mean, what has changed basically since you published your earlier book, like about 5 years ago?
Two things really changed for us. So the original book really documented this change in the economy. Since we put it out, we'd noticed two things. The first thing we'd noticed is that so many of the problems that you hear about working in economics or economic policy on businesses with a lot of exposure to these things, so many of the problems turned out to have some aspect of this change to an intangible economy as a cause, not just things to do with a new economy or digital technology, but things like the effect on productivity, the effect on inequality, questions about planning and land use. Time and time again, we came up with we identified these effects of the intangible economy. So we wanted to kind of flesh that out. The other thing that we noticed was kind of curious. So we and Jonathan in particular has been spending many years researching and measuring the data on intangible investment. And we noticed that in some countries, something rather strange had happened to this kind of ongoing rise of intangible capital in the past few years. And specifically, what we noticed is that in some countries, and the UK was one of them, investment in intangible capital, which had been growing steadily for decades, that growth rate had started to slow down in the recent period. And we thought there were some very interesting things about what caused in some places that growth of intangible capital to start to slow, whereas in other places like the US, it seemed to continue.
Hmm. And why do you think that this? I mean, in the book, I think you call it the great economic disappointment, right? Some of the things that you mentioned, low growth, rising inequality, corporate power. You also mentioned something called inauthenticity about people, feeling that their jobs are not really contributing, to the economy. Why do you think that those, that sort of predicament, why is that so intertwined with the intangible economy? And I guess also, I mean, how does it differ from other hypotheses that seek to explain this sort of phenomenon?
I think what the issue that we identified is intangible capital, from an economic point of view, often behaves in different ways to traditional tangible capital. And we talk about that in terms of it being more scalable, it having more spillovers and various kind of other characteristics. So it makes the economy work differently. And one of the things that this requires is that it requires different institutions to make the economy work well. So to take a classic example, because intangible capital is often sunk, a company that has a lot of intangible assets like brands or software, those assets are not worth very much to a creditor if the company goes bust, which in turn makes it hard to finance intangible rich companies using debt finance, because a lender or a bondholder, one of the things they will look for is security in case the company is unable to service its debt. And obviously, we live in a world where our financial institutions are mostly geared to serving the needs of businesses that can provide collateral. Most lending to most businesses is either a bank loan or, in some cases, a bond. Very, very few companies primarily use equity finance. Um, and that's a great example of something where an institution has arisen to meet the needs of a mostly tangible capital-based economy, but where it's not well, it doesn't serve well intangible based companies, and we find a couple of consequences of this. Firstly, as in this case, you find it harder for businesses to grow. You see a greater reliance on internal finance. You see banks doing less business finance and putting more of their money into mortgage loans, so domestic property finance. Um, and you also see a growth in demand for equity finance. So the kind of the meteoric growth of the venture capital sector in a few places around the world, maybe California and Israel in the last 40 years, has been kind of a response, an institutional response to the needs of intangible rich businesses. And VC-backed companies are kind of the quintessential intangible rich businesses. But it's a kind of transition that is only halfway through, because obviously, and this is a great example where, for all that venture capital is very dominant in Silicon Valley and a sort of relatively important but small part of the world economy, for the most part, businesses are still reliant on bank debt. So we kind of came across a number of instances where it felt like the economy was shifting from one thing to another, but that transition had got somewhat stuck.
Great. Yeah. So now, I mean, you mentioned institutions. We'll get to that in a second. But before we get there, I wanted to ask you, well, maybe a bit of a strange question, but I guess suppose you are actually the CEO of a large multinational enterprise and that is actually thriving very well in this intangible economy. Um, why do you think we should still be worried about these trends, even though you're in such a company?
So I think the first thing, the people who run companies that do thrive on intangible capital, in some ways this is a recognition of what they do and a way of connecting this to broader trends in the economy. One thing I found is when I talk about this subject to technology companies, I get sort of two responses. The first response is, well, yeah, this is what we do.
Yeah.
And then the second response is, but this is for the first time I've seen this actually connected to economic realities and underlying
Yeah.
changes. But I guess one of the things that you do see is that because this is now increasingly important, companies, for example, that own a lot of intellectual property are taking, say, the management of those particular intangible assets more seriously. They're realizing that this is kind of absolutely core to what they're doing, and they're looking at new ways of of making the most of them. I think it's you see some really interesting trends in the creative industries, for example. Creative industries because of their reliance on intellectual property, they have always been in the intangible economy. But I think it's been fascinating over the last decade to see how many businesses in that area have been finding new ways to use their intellectual property portfolio. So to take something that are kind of an aspect of popular culture that everyone is deeply aware of, superhero movies. You
Yeah.
can't go to the cinema today without there being plenty of superhero movies. And this is something that, people who are interested in cinema aesthetically will remark on and say, well, 20, 30 years ago, these kind of movies didn't exist. And I guess if we're looking at this from a business point of view, what this really shows is organizations that own potentially valuable, interesting intellectual property assets like the kind of the Marvel superhero franchises are finding ways to eke them out, to make more of these assets, and to create often extremely profitable businesses as a result. And I think that is that's a huge opportunity for people who already are well positioned in this market.
Yeah, that's some fascinating examples indeed. Now, what I actually also like a lot about the book is that you have all these historical references where, you had earlier episodes where this sort of quote unquote new economies, so to speak, emerged in one economy, but not in others or less successful. So, just very briefly, what do you think are some of the key factors that we can learn from these past episodes? I mean, are they relevant for today's situation? Do you think?
I think we can learn a lot from them. And I think that if I had to summarize the message in one sentence, is that as technologies change, we need, or society needs, the economy needs to update institutions to make the most of them. But let me give a specific example, maybe. One of the things we talk in the book is about lighthouses. So, obviously, in the days when maritime transport was super important, lighthouses were incredibly vital bits of economic infrastructure. They prevented shipwrecks and they made world trade work. And once upon a time, the way the institutions that delivered lighthouses, they were funded by local port tolls. So if you use the port of, I don't know, Dover in the UK or Baltimore or wherever, you would pay the harbour master a toll, and that toll would go to pay the maintenance of the local lighthouse. So the institution was basically a kind of localized tax. But then in the 19th century, there was a big technological change. They invented this kind of wonderful new type of lens for lighthouses called the Fresnel lens. Basically, this kind of wonderful thing that makes lighthouses much, much brighter, much more efficient. So it was a technological change. But it turned out that it totally wrecked the underlying institutions because these new lighthouses were much more visible. They were much more useful, not just to people who were going into a port, but for general maritime traffic. And you couldn't collect enough tolls because the users of the lighthouse, the beneficiaries of the lighthouse, weren't using the port. So it turned out that you needed a whole set of different institutions funded by general taxation or general treaties to deploy these things. And speaking as a British person, there was a kind of tragic instance in British history where Britain didn't put in place these institutions. And so for this period, when Britain was the kind of maritime superpower of the world, its lighthouses lagged behind the lighthouses of France and the United States and other countries because of because we didn't get the institutions right. Lighthouses it's a kind of a very old-fashioned technology, but this is a kind of great example of how when technology changes, you often have to update your institutions in ways you might not have expected.
Yeah, that's fascinating. I really like that story. But so we talked a little bit about institutions, but perhaps perhaps the average listener doesn't have a good picture of what exactly is an institution. Can you explain a little bit more? What do you mean by an institution?
Yeah. So by institutions, we don't necessarily mean kind of old organizations like Harvard University or places that we sometimes call that. We mean kind of in the economic sense of the word, any really established norm for how you do things. Sometimes that can be made up of a number of organizations. Sometimes it can be just a way that we understand business happens as shared understanding. So to give some
Hmm.
examples, um, we talked earlier about venture capital. Venture capital obviously is a big market made up of lots of firms, but it's also in a sense an institution in that there is a shared understanding that you have seed stage capital in various rounds. There's a shared understanding that venture capital funds are structured in a particular way with general partners and limited partners. There's a general understanding of how people go and pitch a venture capitalist and how investment works. So it's a kind of social norm that if you kind of tried to invent it yourself wouldn't stick. But because there's a lot of people who understand that that particular industry works that way, it has a kind of permanence. And those are the kind of institutions we're talking about. Intellectual property law is a set of institutions. The way we regulate market competition, you can think of that as an institution. The way the banking system works is a kind of institutional characteristic. They're the kind of rules of the game that underpin what we all do as businesses working in the economy.
Yeah, that's a great explanation. Thanks. And well, again, we already talked a little bit about it also with the historical examples, right? That you mentioned, we have this shift in the underlying economic structure, but we have the institutions that are a little bit too slow, and I guess also public perception of the reality, or slower to adapt. And in the book, you make a lot of recommendations and different areas where where you think the changes should come. So there's a lot of detail there. Again, I refer the listeners to the book to get a very rich discussion. But if you could make a brief case of how do you think how do should the institutions that we currently have, how should they change? What are some of the major things that we need to update, so to speak?
So let's start with finance, since we've been talking about that, and since that's relevant to businesses in this sector.
Yeah.
Um, yeah, at the moment, we have a system, as we said, that depends very much on debt finance. And part of the reason why that exists is because in most rich countries, debt finance is tax advantaged. So a company can claim interest payments as a tax deduction, but there's no tax deduction for the cost of equity finance. And, this is a sort of really well recognized distortion in markets. It perhaps didn't matter so much in the days when most businesses could rely on debt finance. Most businesses had lots of assets to pledge as collateral. It matters more, and it matters increasingly every year in an intangible economy where actually you might want a thriving equity finance economy to develop. So there's some simple tax changes. I mean, these are big tax changes, but they're things that have certainly been under consideration that people like the OECD have been talking about for a while. There are a number of countries who've been looking at or implemented forms of equity tax credit. So there are some sort of legal changes you can make like that. By the same token, there are other things when we look at, there are things that market participants can do. So I think it's fascinating. I've found it fascinating the way the venture capital sector has been changing over the last 10 years. You're seeing larger funds, you're seeing funds being more willing to follow on, responding to that thirst for equity capital. You're seeing more growth capital and more firms that were traditionally in the kind of leverage buyout space expanding into providing what I would think of as more growth capital, so primary equity investment for people who want to invest in more intangible capital. And I think to some extent you're also seeing an interest in the part of banks in terms of how they can do enough due diligence to be able to back companies that make intangible investments. So all of those things would help. It's a big challenge because obviously the banking system is slow moving, and to some
Hmm.
extent slow
Yeah.
moving for good reason. You don't want the banking system to be kind of jerked around by the latest trends.
Yeah.
But this is the kind of thing that we need to gradually change over time.
So let's look a little bit into the future, actually. So let's assume we're in this perfect reality, and sort of most of or all of your the things that you argue for, all of your solutions are sort of adopted. How do you think that future looks like? I mean, in terms of the sort of economic disappointments that we had over the last decade or two, how would that play out, do you think?
Well, let me talk specifically about the UK example because that's a nice example of a country where intangible capital growth has really fallen off
Mm.
in recent years compared to a strong growth rate in the years before. Just running the numbers and looking at what would have happened to UK economic growth had intangible capital growth continued at the rate that it had prior to 2007. Um, we would, every household in the UK would be around, £5,000, sort of $7,000 richer. And to give an idea of the dimension of that, that is kind of about 50% higher than the expected increased household costs from the current energy crisis is expected to spike. So this is a kind of a really material difference to
Yeah, it's
standards of living
significant, right?
in
Yeah.
countries like the UK that have fallen behind.
Yeah, no, it's significant indeed. That's It's fascinating how you connect it to the current cost of living crisis and the extra amount of money that people now have to pay for energy. It's pretty significant indeed. But again, looking a little bit forward, how do you think, if you were to advise a business on, on these issues, what do you think is a realistic outcome? I mean, how should business prepare for the decade ahead in terms of,
Looking for
factors
additional
that we
business
talked about,
insights in this
with regards
subject
to
area
the
and beyond this
intangible
podcast,
economy and
go
some
to
of the institutional changes
tcb.org
that may
and
or may not
explore our
happen?
Human Capital
How
Centre.
would you
Uncover a
advise
large array
business?
of products hosted by the Conference
think
Board in focus
in some
areas
ways, so
like
we
diversity
talked
and
earlier about
inclusion,
businesses that are
talent
already
management,
that
and
are already
many
kind of
others.
masters of intangible capital.
Products include
And for them, this is
peer-to-peer
really a question of
networking
just
events,
of,
expert briefings,
of just doing more.
publications,
Where I think it's particularly
data and
interesting is for
analysis,
companies that maybe aren't so
webcasts,
invested in
videos and
tangible
blogs.
capital at the moment. So businesses that own a lot of tangible property, own buildings, own machines. And I think what is interesting there is we've seen a number of instances of companies that have done a really good job of plugging in to the growing importance of software, of data, of other intangible capitals to make the most of their assets. So finding ways of providing of providing assets that can take advantage of intangible capital. So to give to take one specific example, if we look at the restaurant business is a restaurants and hospitality are a pretty tangible capital intensive sector. You have to you physically eat food, you have to have a physical kitchen to cook the food in.
Yeah.
A big development in that sector has been the growth of dark kitchen businesses and businesses that do a really good job of plugging into these new online platforms like Uber Eats and Deliveroo and Just Eat. And the ones that have been able to do that really well, or indeed in some cases have built their own ordering platforms, have profited despite relying heavily on tangible assets. One thing that people have noted is that one of the highest performing stocks of the last couple of decades has been Domino's Pizza. Domino's Pizza, obviously a very tangible capital intensive business,
Yeah.
but that did a fantastic job of basically plugging into the online, the intangible based online delivery market. They got those interfaces right, and so it is still an intangible rich business, but it's increased its market value very considerably by getting that intangible integration right.
Yeah, that's fascinating. It's not just the new intangible economies. I mean, there are plenty of sort of old economy tangible businesses who also take the opportunity and thrive. Yeah, that's fascinating. Now we're nearing the end of our interview. I wanted to end basically by some other questions. I wanted to ask you about your favorite reads. Well, first of all, do you like reading books? And secondly, what are some of the books that particularly inspire you?
So I love reading. I'm a particular fan of reading economic history books. I find I learn so much from it. And it combines my love of history with my interest in economics. Um, I think sorry. I think so. A book I've read recently that I've been absolutely fascinated by is a book called How the World Became Rich by Mark Koyama and Jared Rubin, which is kind of a survey of the economic history of how the world went from being a basically subsistence economy everywhere to many parts of the world massively increasing GDP. I've just found it a incredibly good survey. It kind of was enough detail if you really want to go into the literature and understand it, but totally accessible for someone without a kind of an academic background, and telling kind of in some senses the biggest story there ever was about how human beings went from global poverty to some semblance of prosperity.
So yeah, no, I think that's a nice, perhaps a possible suggestion for a future off the shelf podcast. Again, as I mentioned before, I thought Restarting the Future, your book, was a fascinating read. And I would say to our listeners, if you like this conversation, where we obviously just scratched the surface on some of the issues, if you want more detail and you're really into this topic, I really encourage you to get a copy. It's a great read, and you finish it in no time, basically. So I would say thanks, Stian. Thanks so much for coming, joining us today and sharing your insights on your book. It was a pleasure having you.
Thank you so much for having me. It was great to discuss.
Good. And I would say to our listeners, if you enjoyed this episode, please remember to subscribe to our off-the-shelf book discussion podcast series, or perhaps explore the entire catalog of podcast programming from the Conference Board. You can do that by visiting our website at tcb.org/podcasts.
This has been Off the Shelf, a podcast by the Conference Board.